Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we're going to be analyzing Tapestry stock, ticker TPR. This one came in by request down in the comment section of one of my other videos. If you have a request you'd like me to take a look at, just drop it down in the comment section and I will get it on the whiteboard behind me and eventually I'll make a video for you. If it's a stock that's in the S&P 500 like Tapestry is, I post those on YouTube for free. The rest I post on Patreon and in the full Cyclical Investors Club service over on Seeking Alpha. Patreon's $5 a month. If you join there, you can get a big discount to the full Cyclical Investors Club service if you ever decide to join there, and those links are down in the description. I also have a 25% off discount link for Fast Graphs, which you'll see me use here in the video. I've been using it about 5 years, and it allows you to sift through stocks really quickly and kind of narrow down the ones that may require a little deeper investigation. So it saves a lot of time. I get a little commission if you go through the link that I have in the description there, so that helps out the channel. And as always, this is not individual investing advice. This is just how I analyze stocks. So, Tapestry. This is an interesting one. Luxury goods, basically, apparel. And I don't currently track this one. The short story is I think it's just too hard to predict like what they're going to do in the future. If you look at their earnings history, which is the green area here, the dark green area, we see that they definitely had a period of fast and steady growth from the early 2000s or before all the way up through 2013, and then earnings started to come down, and they kind of leveled off, and then they never really fully recovered to those old highs before COVID hit, and that caused a bust, then a boom, and so far we haven't had a bust yet for their earnings post-COVID, and so that's where the big question marks I think come in. But this is kind of when you have a finicky business like this that's based on like fashion trends, it's really hard to predict medium and especially long-term returns, earnings growth basically, and then therefore the returns that follow. So when I see this, where they really haven't until the kind of post-COVID or COVID stimulus boom, until then, they hadn't really recovered their earnings highs from 2013. That would be enough for me to just kind of lay off the stock. Now, they could, over time, turn the earnings around, turn the business around, and regrow again and go reach another high. And that looks like what they may be able to do. It's very hard to tell. But they recently announced a purchase of Capri. So what happens is when growth stalls out, which is really what's happened here, the business has a few choices to make. They can try to just maintain kind of where they're at and give a dividend, to shareholders. I'm not sure what the dividend yield is here, 3%. So it's okay if they were growing it, let's call it high single digits per year, then a 3% dividend yield could make sense. But what they're purchasing Capri tells me is they don't think that they're going to be able to grow kind of organically. Like they want to mostly defend kind of where they are now. And so that makes me question, we've had this recent boom, and you'll see this with a lot of stocks if we zoom in to kind of the post-COVID era or COVID era, they're growing like 10% during this time. And it hasn't come down yet, so we haven't really seen that happen yet, according to these earnings. But we are looking at kind of high single digits earnings growth, a 3% dividend. If they hit this 8% growth rate, all this looks pretty standard to me. So, I mean, if I just had to put an opinion out there, I would say it looks kind of fairly rationally valued by the market given everything that we know. But I also know it's very hard to predict what these kind of fashion trends are going to do in the future. Also, with acquisitions usually come more debt. I don't know if that's included in here, but if you were looking at the PE ratio of 11, if they really do have debt to capital about 75%, you think you add 75% to this PE ratio, and you're getting up to like a 19 PE, probably 19 to 20. Well, that's a little lower maybe than the market, but for this type of business, I mean, it's not like a software business. That seems pretty much in line with the market. So again, all this, I wouldn't look at this PE and think it's low. That to me is just normal. That would be like a normal PE that I would expect. If we look at Capri, because this hasn't gone through yet, we can see the type of earnings that I would actually expect to see a little bit more. Let's open this back up. So they have this fast growth period after, maybe this was an IPO. This used to have a different name. There's a couple different companies that merged together. I think Michael Kors was one of them. I can't remember all of them, but so they merge and then they change the names, and you lose track of them. But so we have this fast growth period, then it basically just stops. And then even before COVID, we started to see the decline. We saw the COVID decline, which is totally understandable. People are staying at home. They're not worried about their fashion quite as much. And then as soon as we get the stimulus, we get the boom. And then with Capri, we actually are seeing the bust, right? So this is actually what I would expect to see. And this is coming in right where they left off kind of before COVID, right? So that would be pretty expected of me. So I think really the only way that a buyout of these guys is really just to consolidate, market power, market control, by having more brands under the same umbrella. I don't know a ton about like fashion distribution and things, but I would imagine it gives you some economies of scale and negotiation power and things like that if you have a bigger business. So it's not really reaching out for growth because Capri wasn't really growing it anyway. So yeah, I mean, I think there's risk it doesn't work out. There could be new competitors that come along in the market that are hard to predict ahead of time, that could take market share from the bigger guys here. But if things work out, they'll probably hit this 8% growth, and they'll probably be able to maintain that 3% dividend at these levels, and it will, and I think that's what they're kind of aiming for. Like, this is what they want. It's probably the reason that these estimates are here is because that's the guidance that they're giving analysts. So you can see what they're aiming for, but it's very hard to know whether they're actually going to be able to do it or not with this type of business. So for me, this is just too hard. I kind of put it off to the side. I want to find a business I can have a little bit more confidence in, it that has maybe a little bit, better moat or a longer, steadier history. These could be economically cyclical as well. They might hold up better because they're higher end, and I think the wealthier part of the economy isn't going to be hit quite as hard by this, whatever the next recession looks like, unless it's really bad. So they might not be super duper cyclical in a downturn. I think last time they were just a little bit, might be a little different now that they're bigger, but so wouldn't be super worried. I'd put it like the same, just average market risk probably as cyclical risk as the rest of the market. And I guess those are my thoughts. I don't really have like a valuation that I've worked out because I don't track this one, but a 19 PE at an 8% growth rate is a 2 PEG ratio. So, I mean, that's just market average, right? If it was down here, and you thought you had confidence in the future growth, then you're looking at a more attractive price probably. So maybe if you bought it down here and you're wondering whether you should sell, I don't think there's necessarily a reason to sell. It's about average priced for the rest of the market, unless you saw some kind of downturn coming. Okay, hopefully that helped a little bit. I know it's a bummer sometimes when I don't really have too much to say and can't crunch the numbers too much, but sometimes you have to just admit that you don't know what's going to happen, the people on Wall Street will not never say I don't know. But I think this one's just a little bit too hard once you get like 5 years into the future to know what it's going to look like. All right, thanks for asking. If you have a request, put it down in the comments section. If you found this useful, hit the subscribe button, and I'll see everybody later. Bye.